Good afternoon. My colleagues and I from Performance Consulting will be analyzing the opportunities and threats of the dual track approach and from there provide recommendations on how to maximize value for our current shareholders.
Currently, Ildis owns 33% of Ak Gida, while Tobas owns 37% and others own 30%. Secondly, based on initial market valuation, Ak Gida is worth between 696 to 834 million USD, which mirrors Lectili's current offer and IPO value. Thirdly, Ildis is undergoing a strategic shift and thus intends to cash out on Ak Gida. Should Ildis proceed with a sale, their relationship with Tobas will be strained, while proceeding with an IPO will result in a diluted ownership. Thus, to determine which is the best approach, we will consider both options' qualitative and quantitative reasons.
We will first evaluate the IPO option based on the quantitative and qualitative reasons.
By proceeding with the IPO, we can be certain that Ildis is able to limit its supplier's risk. We know that Ak Gida was originally started as part of Ildis' vertical integration strategy. Proceeding with the IPO, Ildis continues to have complete control over a supplier. By ensuring they receive quality milk, it allows them to continuously produce quality chocolates and biscuits. The second reason to proceed with the IPO is because Ak Gida has made their intention to IPO clear to the market. If they were to pull out of this IPO in favor of the strategic sales, regulators and investors may not be too happy with this outcome, and Ildis risks a backlash due to them having other stocks available in the market. For example, investors may start pulling out their investments from these other stocks. Thirdly, we know that the Uker family, our boss, values the relationship with the Tobas family, and we know that Tobas rely heavily on Ak Gida. By deciding to proceed with a strategic sales instead of an IPO, Tobas risks losing a key supplier, and because of this, the relationship Ildis has with Tobas will be strained. For these qualitative reasons, the IPO option should be considered seriously. Besides these qualitative reasons, we also need to analyze the quantitative reasons. According to the projected cash flows of Ak Gida, we will receive 7 million in 2015, 154 million in 2016, 186 million in 2017, 215 million in 2018, and 252 million in 2019. Everything in Turkish lira. However, the figures are a projection of the strategic sales option. Thus, we have to add in the amount saved from brand acquisition, which is 50 million. And because they still do not own the brand, they will have to pay brand royalty, and this is assumed to be paid yearly, and each yearly payment is approximately 45 million, considering that is the amount they are projected to pay still for 2015. Thus, the final yearly cash flows are 57 million in 2015, 109 million in 2016, 140 million in 2017, 169 million in 2018, and 207 million in 2019. Using these cash flows, we'll now discount them so that we can get a feel of what is the real value of keeping this asset to the current shareholders. But several assumptions has to be made first, before we can use the discounted cash flow method. The growth rate is assumed to be pegged to the estimated GDP growth rate of Turkey up to 2019, which is 3.8%. The debt to value and equity to value ratio is based on Ak Gida's 2014 debt and equity figures. Using this information, the weighted average cost of capital, which is our discounted rate, is 9.92%. Thus, based on this assumption, the terminal value of 2019 is 3,152 million Turkish lira, and using these figures and cash flows mentioned earlier, it can be discounted back, and thus the NPV of Ak Gida's assuming the IPO option is followed suit is 2,682 million Turkish lira. As the current shareholders will own 55% of the shares of the IPO, to them, Ak Gida is worth 1,475 million Turkish lira. Besides this value, we also have to consider the amount they have sold the company for. As given, the firm is valued between 1.85 to 2.21 billion Turkish lira. As they are selling a 45% stake of the company, they can earn 832.5 to 994.5 million Turkish lira. By summing the average amount earned from proceeding with the IPO option and the value of retaining Ak Gida, to the current shareholders, the IPO option is worth 2,389 million Turkish lira, and using the exchange rate of May 2015, the IPO option is worth 901.4 million USD.
I'll now be talking about the qualitative and quantitative reasons as to why Ildis should proceed with a strategic sale.
With a strategic sale, there are many value add to Ildis, which will eventually lead to an increase in value to the shareholders of Ildis. Firstly, With the recent acquisition of United Biscuits, the sale of Ak Gida will allow Yildiz to focus on its core strength of biscuits and confectionery in line with their new strategy. Secondly, being a minority shareholder and doing the main work of operating the company, Yildiz suffers a disproportionate effort to reward, which will no longer be the case if they move forward with a strategic sale. Lastly, Ak Gida was the asset that consumed the most time and yielded the least returns. In order to maximize rate of return to the shareholders and grow Yildiz holding further, it is essential to get rid of Ak Gida. This can be achieved by proceeding with a strategic sale of Ak Gida to Lactalis Group. We have performed a projection of the intrinsic equity value of Ak Gida with the use of a discounted cash flow model. As shown, we have used the same assumptions as our IPO projections as mentioned by my colleague previously. Using free cash flow to the firm from Ak Gida's cash flow projections prepared for the strategic sale, we arrived at a terminal value of approximately 4,283 million Turkish lira and an enterprise value of 3,248 million to Ak Gida, which is derived from the net present value of forecasted free cash flow from 2015 to 2019 and the addition of net present value of terminal value. Adjusting for cash and debt, we arrived at an equity value of 3.2 billion Turkish lira, which is approximately 1.2 billion USD, using the exchange rate given in the IPO offering price as of May 2015. For our sensitivity analysis, we used a low bound growth rate of 3.8% as used in our discounted cash flow analysis, and an upper bound growth rate of 4.8%, which is derived from Turkey's forecasted average dairy market growth rate. Using our weighted average cost of capital of approximately 10%, derived from our assumptions from the discounted cash flow, we implemented an upper and low bound for our sensitivity analysis using a standard deviation of 1%. With that, we arrived at a valuation range of approximately 1 to 1.7 billion USD.
After considering the qualitative and quantitative factors for both the IPO and the strategic sale, we will now look at the opportunities and threats by both and make a recommendation.
In analysing the threats present for both approaches, our team has identified 6 key factors ranked from low to high threat levels. The supply threat is absent for an IPO option and limited for a sale, as unlike the mid-1990s, there are numerous dairy suppliers currently readily available. Thus, there will be limited impact on operations. The tension in relationship with Tobas is absent for an IPO, while a sale will strain the relationship to a limited extent. This is due to the strong bargaining power Yildiz Sok and Tobas BIM supermarkets have over Ak Gida, as these two supermarkets generates over 50% of Ak Gida's revenues. Disappointment with regulators would be absent for IPO, but control should a sale occur due to widely publicized knowledge that Yildiz is pursuing a dual-track approach. With a shift in strategic focus to biscuits and confectionery, a sale of Ak Gida would allow Yildiz to allocate key resources to pursue this strategy, resulting in improved efficiency. Due to the diluted ownership post-IPO, there's a high disproportionate level of returns should an IPO proceed. In consideration of the above factors, a sale of Ak Gida represents the lowest strategic threat to Yildiz Holdings and is the recommended approach.
We will now go through the approach to take during the Lactalis negotiation to achieve a favourable outcome.
During negotiations with Lactalis, 3 scenarios, good, expected, and bad, would likely occur. The good and bad scenario represent the upper and lower bound valuation in the sensitivity analysis, while the expected scenario is the derived value from our DCF model. By acquiring Ak Gida, Lactalis will incur lower cost, a quicker time to market, and be exposed to lower overall risk compared to developing their own subsidiary. Ak Gida also represents an easy way for Lactalis to penetrate the Turkish market, which already possesses significant market share and large potential for future growth. Lastly, Lactalis would be able to eliminate redundancies from its existing operations, and through the combination of activities in its value chain, Lactalis would benefit from economies of scale and scope. Further, by leveraging its existing competencies, the synergy derived from Ak Gida will cement Lactalis' position as a key market leader. Thank you for your kind attention.